Peter Rose, Longwood Currency Trading. It's mid-April of 2022, beautiful day. We'll go outside and chat a little bit, but I wanted to preface that with the purpose of this video so that you can see where we're going to go with this thing. The title of the video is Forex Trading Based on a Rules Framework. What does that mean? Look, trading Forex is very similar to driving a car, for example. There's some basic things that you need to know, and after you learn that stuff and you become experienced, and that's the key word, with all of that, rules and the operation of the car, then all of that stuff can be molded to fit the different conditions that you're going to meet on the road. In my videos here, I discuss principles. I discuss principles of a framework. And it's a framework of rules which then change under real-time conditions. And I want to kind of go through that and explain that a little bit. So let's take a walk outside. It's windy. I hope it doesn't interfere with the mic too much, but we'll go out, check it out, and see what's happening. Here we go. All right, so we're outside. It's a beautiful day, as you can see. Well, you know, we're just starting up here in New England to kind of get ready for spring. It's been chilly at night. We haven't had a few days of rain before Easter, and then it rained Easter evening, I think, a little bit, and we've had cold weather at night, but the spring is coming, and let's walk up here and I'll show you Sue's daffodils that are coming up. We looked in a video a couple of weeks ago at the ones over by the barn coming up, so we'll take a look at these, and there they are. So what's causing this particular video to for me to chat about this stuff? You know, everybody would say, well, yeah, you have to have some rules, and those rules have to change. Well, in conversations that I've had with several of the folks that I communicate with through email, there's been this, and we do video chats with some, and some of them through email. But in particular, I was talking with Dylan. Hi, Dylan. About some of the trades that I was doing. In fact, I was in a trade. I was 2 lots in, and then it was against me, and then as it started to go in my favor, I was staging in more lots, and we were chatting about that process as we were talking, and he said he was a little confused because it isn't exactly the way that I generally trade myself in the discussions that I make on these videos. You know, I'm fairly rigorous about you know, 8 pip stop, and you know, you can make a good living at 5 pips if you have a large enough bank to do that. I mean, 5 pips on a 10 full lot trade's $500, right? So you have to take those things into consideration. You know, there's a lot of wind out here. Maybe we'll just wander on back down and make sure that the sound quality doesn't go south on us here. So the appearance was, gee, when you talk in your videos about this stuff, it's different than what you're saying that you do. And you know, I'm critical of the folks that talk crap about teaching Forex trading, and they're giving all these rules and using all these indicators and crap, and that isn't the way that they learned how to trade. That isn't how they became successful. What they're really doing is they're protecting the money that they earned because they don't really know how to trade. They don't really know what happened. They think it was because of a friggin' Bollinger Band, and it wasn't. It was because of something else. And instead, they don't know what that is, or they don't know how to teach, and so they present it so that it looks like all these rules of risk-reward ratios and all this stuff that they talk about is the legit thing that's gonna make you a good trader, and it's really not. those things could be used maybe later during the position management stage of the Forex pair, but not at entry. That's not how you get successful. You have to get that entry thing right. Here's our book again. Maybe I'll shut up this time so you can hear the water. I have to get somebody to come over because my wife was out kicking a small rubber beach ball around for the dog, and it went into the drain pipe that goes under the yard here and comes out there. So we got a beach ball in there somewhere, and there was this winter that'll just get plugged up in there, and the thing will overflow, and we'll have waterfront property here. So we got to kind of fix that. So let me go through the clutter of going inside, and let's talk about this in real time. All right, so we're back in the library. It's a little calmer in here, and here's to it. Still no coffee. I'm still coming back from this gastrointestinal and viral infection that I had. So I haven't had a cup of coffee in 2 weeks, and that's getting a little old. So am I being hypocritical then by teaching one thing and doing something different? Well, in reality, I'm not doing anything different. I'm just molding the parameters to fit the real-time situation based on price action. Okay, and price action is order flow. That's constantly changing. So when you're trying to build your framework, you can't build a framework on these constantly changing situations. What you do is you build your framework of rules or guidelines, your methodology of trading, based on not so much the happy path, but what you would consider normal conditions for the currency pair that you're trading. Now, if you're trading 15 different currency pairs and the Bund and the DAX and gold and all that other crap, I can't help you. That's not going to make any sense to you. But you look at the characteristics of price action of that currency pair over the long term. You're trying to flatline the thing like a 200 period moving average or whatever, or a 200 period ATR or what's that median range of trading that price goes in? What's the periodicity of the swings? What percentage of the retracement to the trend that you're following? What percentage of that is that retracement of that trend? All those general things are general guidelines. You know, when you go to learn how to swim, you generally don't do that in the ocean, right? You go to a little pool where there's no waves and there's nobody else in the water, and the water is fairly warm, you know, so that you don't go freeze your ass off as you're in there and say, I don't ever want to swim. There are all these conditions that eliminate a lot of clutter so that you can focus on what you're supposed to be learning how to do, which is swim. Well, once you know how to swim, you can swim in cold water, hot water, swim in the ocean, swim in a lake, swim in a river. It doesn't make any difference. Guppy pool. Well, swimming. Now, if you learn to swim in a small lap pool, for example, and then you go out in the ocean and there are waves, you're going to have to change the way that you swim. Maybe the number of times that you turn your head to come up to breathe. Or maybe you're not going to do the backstroke in the ocean. Okay? You get it, right? And so why would you do your trading any other way? Why would I get on a video and teach crap that's only going to bring you a lot of failure? 90% of the traders lose 90% of their money in 90 days. And I constantly ask the question, why is that? Is everybody stupid? Is it all that difficult? No, to either one of those. It's the education. And what is the education filled with? Indicators, moving average cross, Bollinger Bands, fucking bat patterns, RSI, all that stuff. You know why it doesn't work? Because all that is what happened in the past. The guy that's executing from the institution his $2 billion order, and he's piddling that into the market, doesn't have anything to do with what he did 40 minutes ago, unless he's entering the same trade thing that he did 40 minutes ago, because he doesn't want to swamp the market with his huge order. Price action is based on order flow. You know that. Well, what does the order flow that happened with a moving average cross or an RSI or any of that stuff? It's all delayed information. That's like saying, well, after the burglar breaks in and he's looted part of the house, I'll contact the security service. That's delayed information. By the time the security service gets there, the guy is gone. You've lost all your shit. And that's what's happening to your money. You're thinking that such and such events are taking place right now. That's not the case. They took place before. You have to base what's going on like right now. And so the framework that I have as a basis deals with the reality of right now and what that normal price flow looks like. Call it a happy path if you want. I mean, when you do project planning and you do your PERT diagram, that's what you have. You get your happy path, you got your worst case scenario, and then you have all these other paths that go through, and you pick the one that's most likely to happen based on your experience of building project plans for whatever it is that you're doing. And that's why would you do it any other way? Now, because you're trading a couple of minis right now, doesn't mean that when you start trading 2 fulls or 10 full lots, that you're going to have to change. Well, and that's the problem, because people will do something in a shorter time frame stuff, and it doesn't duplicate up because they're not trained correctly. They're not based on a framework. Oh, I'm gonna learn how to trade on a 15-minute chart, and then I'm going to trade the 4-hour. You're screwed unless you understand the principles behind what it is that you're doing. And don't you know that those indicators change in their significance based on the time frame that you're looking at them on? Same chart, different time frame. The indicators are singing a different song. And so, I don't mean to confuse those of you that I talk with or communicate with, that, oh, I'm sitting here with a 4-lot position that's a couple of $1,000 south, and it's far more than the standard 8 pip stop that I would have taken, that I'm so adamant about, because I'm molding that particular position based on what my profit target is. You know, I say in my videos, well, I'm not going to go into a trade unless there's a 20 or 30 pip potential profit. But if I see certain conditions building, and I see that the potential long-term possibility is 100 pips or 200 pips. Look, I've had positions go 100 or 200 pips against me after I've got out. So I'm glad I got out. Sometimes I didn't get out. It's nothing on the major currency pairs, which have ATRs of between 80 and 120 pips a day, to have within a few days, even a couple of days, price go 200 or 300 pips in the other direction. How do you know how far it's going to go? You don't. And so you're really concerning yourself with, well, what's going to happen, well, if you're on a daily chart, for example, what's going to happen 5 or 6 days from now? And your second issue is what's going to happen next. I'm at the hard right edge. What's going to happen next? Those are your two analysis things that you have to go through. If you see this great target and you've studied the economics of the two countries and you say, it's probably going to go way out there. Well, you're not going to dump in your whole load right up front and try to get all your pieces in place in the first 20 pips and be carrying your full load in the first 20 pips. Maybe you go in with one lot. And after it goes 20 or 30 pips in your favor, you go in another lot. And you gradually stage it in so that your average price is way down there and it gives you a 30 pip swing. Breathing room. Of course, you're still going to make 20 or 30 pips when the stuff comes down and you get tagged out at the average, above the average price, right? So that was a good couple of days. You didn't lose anything, but you have to plan for it. But you can't go in with a rigid set of rules and put those rules to work in all the varying conditions that you're going to come into. It doesn't work that way. The rules that I teach and the rules that I have work under certain conditions. We call them training conditions. And when I work with a student, I don't work with them for 5 days or send them a course book or something. We're doing consulting work. Is it expensive? Yeah, boys and girls, it's really expensive. Don't fucking bother me unless you're serious about wanting to get at least a $30,000 account and you want to trade a six-figure account. That's where your goals are. If you're looking to trade 3 minis or a full lot and make a couple of $1,000 a year, it's not going to be worth your money to pay me. Just listen to my videos and try to get the most out of it that you can. But don't ask me what my prices are because it'll blow your roids out. Cost me $40,000 to learn what I'm doing, and that's why and as a software engineer for 33 years designing business applications and a physics degree, I know how to put this stuff together. I know how to build frameworks, and that's what I have, and that's why I know that whether I'm trading in the standard price action activity, whether I'm trading in a high volatility situation or doing an NFP coming up, or I've decided to shift and go to trade off a daily chart, all those principles are the same, but the rules need to change. If I'm going to go and want to stay with my trade for 5 or 6 days or maybe 3 weeks because I'm looking for that run to go with 400 pips, it could do it in a day. You know that. You've seen your charts. But, average price may increase 5 pips a day, 20 pips a day on a daily chart, right? So tomorrow's close will be 20 pips higher than today's close. But it could be an ATR, 80 to 120 pips, could be 100 pips, could do that 4 days in a row and I'd get to my target. But that's not the normal path. Even as your momentum starts to increase and your price is moving upward, the changes in the momentum and the magnitude of that bar change is the signal to change your thinking from a short-term day trade of maybe 20 pips and you're hoping to get 15, and you may change that to, oh man, let's look at a 200 pip profit target. So you might have gone into that trade as a day trader with a 20 pip profit target and an 8 pip stop on a 5-minute chart with a 5-period ATR, and see that the momentum has changed, and that's based on the candle size. Obviously, I've talked about that a little bit before. And you say, well, wait a minute. Not only has the characteristics for a good day trade occurred, but now the price action is manifesting itself into a longer term trade. Now, whether that'll be 25 minutes or 2 hours or 2 months, that's immaterial. Now you have to shift that framework rule in thinking in terms of, well, it's getting close to the 15 pips that I had a 20 pip profit target, and I'm really looking to get the 15. I'm not trying to pick tops and bottoms here, boys and girls. I'm just trying to get the guts. So I'm looking at that 15 pips, and it's getting toward that 15 pips, but it's starting to weaken. I'll get out with 8 pips profit, or I get out with 10 pips profit. I do that all the time. But if that price really looks, and other conditions really look like it could expand beyond that, do you think I'm going to trail my stop by 8 pips? Or do you think my entry stop is going to be 8 pips? No. That has to change, because then the price needs to breathe. Does the price, if I'm looking at a 400 pip profit target, does then on a 1-to-1, does my risk then become 400 pips? That's asinine. Well, what are you going to do? 100 pips? And you got a 400 pip profit target, and you got a 100 pip risk. That's a 4-to-1. It doesn't mean shit. I'm telling you, anybody that tells you that is full of crap. This risk reward stuff is stupid beyond comprehension. There are ways to think about how you deal with risk and the amount of profit that you have. It's called win-to-loss ratio. But it's not risk to reward. Getting back to the issue, though, if I'm doing the day trade, a 5-minute 5-minute ATR with an 8 pip stop and 20 pip profit target, and things turn around, I said, well, this thing could go to 400 pips, could go to 100 pips. I'm not going to take a 100 pip risk. I'm not going to change the 8 pip risk to a 100 pip risk, but I may give it 20 or 30 pips, because I'm at the point where I tend to stage into my positions. As someone with less than a couple of years of trading, or a year of trading, or 300 trades, you shouldn't be even thinking about staging. I don't teach staging. I recommend against staging. I recommend against compounding. I recommend against anything that takes any kind of sophistication until you have a good win-to-loss ratio and a solidly growing equity curve. Why would you do it any different? Look, if you can't trade one mini lot and make that 0.5% a day over a long period of time, you got no business doing anything else, much less adding to the size of your bank. Once you understand your rules, that's proved by your equity curve. Now you can start to add money into the into the bank and start trading larger and get used to trading larger, but you're still only trading based on that size. Let's say you go to 3 mini lots. Well, you're gonna trade for $3 a pip. Then, if you go to a $30,000 account, you're trading for $30 a pip. You trade a $300,000 account, you're going for $300 a pip. So you're managing that, but you're going in with that 3 minis, or you're going in with the 3 full lots. You're not staging in with it. What are you going to do? You're going to stage in with a $30,000 account? You're going to stage lots with a $30,000 account? You better be pretty good to do that, because if you can't just trade the 1 mini and make money, you're not going to trade $30,000 account, trade 3 fulls and stage them in, or over leverage yourself with a $30,000 account and try to trade 4 lots or 5 lots or stupid. But you shouldn't be trading it over 50-to-1 leverage anyway. All the smart countries have limited the amount of leverage that you can use. You could still get 500-to-1 leverage if you go off, I don't know, Cyprus or somewhere. You really want to trade with 500-to-1 leverage? You really want to trade with 100-to-1 leverage? What are you, crazy? If you really, really, really know what you're doing, you don't need to trade with that kind of leverage. It's too much risk. Because when it goes wrong, you lose your whole account. Now, there are some pro traders out there, I won't name them because you'll all want to go and do that. There's a guy that'll lose $40,000 to $100,000 a day and not think anything of it, because when he hits it's an 8x on these highly leveraged positions. So, and he's very successful. He's a millionaire in every currency that's out there, right? So he knows what he's doing, and he's trading with far more than $1 million. There are guys out there with multi-million-dollar accounts, and they trade with very small pieces of that because they really know what they're doing. They'll trade with a $30,000 or a $40,000 account, and they'll just go in. As one of the folks that I've had some experience listening to. I trade small and I trade often. Can you do that? No. You have to learn the basic mechanics. You have to learn a good, solid framework. So when you're listening to my videos and I say, oh, geez, I just got tapped out, I lost X amount of dollars, and you do the calculation in your head, and you go, you took a 20 fucking pip risk or a 50 pip risk. What are you doing? Well, I was doing something totally different than out of the norm. And so if I lose 50 pips, then where do you think my profit target was? 20 pips? No, I don't think so. But I lost the 50 pips. Now that's going to take me some time to come back trading my normal way at an average of 8 pips a day. Or 15 pips a day. I'm a better than 60-40 trader. So I manage that loss size based on how many days on average it will take me to come back from that. And I have to balance that and say, do I want to lose 18 days of trading to make up for this stupidity or this assumed risk? No, I don't. If it goes wrong with me, I don't want to spend 18 days coming back. I'm willing to spend maybe a week. But that's me. I've been looking at the currency market since 2007. How long have you been looking at them? So when I'm talking about stuff that I'm doing, you have to put that into the perspective of all the other stuff and the framework. Where is that coming from? Is that based on, oh, geez, I think I'll trade the dailies today and pick a 300 pip profit target and I'll take a 200 pip risk? Where does that come from? Where would that come from? You wouldn't be looking for a 300 pip profit target and taking 200 pip risk on my team anyway. That isn't going to happen. I won't tell you what that risk is, because that risk would be determined by the price action at the particular time the trade was executed and how likely we were to be able to get into profit with our initial staged in lots, so that we could then zoom the stop up to a break-even position. And what a pain in the ass it is to sit with that trade for 6 or 8 days before you get to that next couple of, or you've gone through a couple of staging positions and you've moved that stop up and it comes back down and you're out at break-even. You spend all that time and you're out at break-even. Or you spend all that time, like I had a video that I put out, I made $3,600 on the trade, but it took me 90 days to do that. Yes, it's 2% a month on the bank that I was using, but I wasn't paid for the time that I had that trade on. Yes, I made the $3,600. Great, let's clap for Peter. But let's focus on where in the framework did the impetus for that come from, because I held that trade for 3 months and it was massively underwater. I'm not going to teach that stuff. I will teach a framework that will allow you to make the decision to do something like that, but we have to clearly distinguish between what's real and what's tomorrow when you have more experience. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.